Hello class, welcome to our discussion of Chapter 5 and Itemized Deductions. Now, before we get into this today, we want to make sure that we understand how these work in the tax law. Alright, so itemized deductions are only valuable to taxpayers if the total itemized deductions are more than their standard deduction. It is an either or. That's the situation. So as a tax preparer, you are looking at the situation and deciding whether the standard deduction is a higher and means it'll reduce your taxable income more, or if using the itemized deductions. When someone says, "Well, can I deduct a certain thing under itemized deductions?" the question is, answer may be yes, but only if you have enough total itemized deductions to be more than your standard deduction. Otherwise, it won't really be deductible in the sense that there'll be no tax benefit to you. And with the increase in the standard deduction in the end of 2017 tax law, a lot fewer people are going to use itemized deductions. In addition, they eliminated in that tax law change some of the itemized deductions that had existed. All right, so now I will tell you that below in our module there is a reprint of Chapter 5 from your textbook after the tax law. I mentioned it last week. The last minute tax law passed at the end of December that messed things up, or changed things, I guess you should say, after the textbook was published. And so they redid Chapter 5, and that is in your right below this information. The biggest change really had to do with medical expense. You'll see as you go through, the changes are in red through the text, but we want to make sure that we utilize that when it comes to our homework and so forth. And I'll point out the change as we go through this. We're going to talk about itemized deductions as they show up on Schedule A. So Schedule A is where everything is listed, and it's had the same order for years and years. And so we'll kind of deal with it as you would if you were going down the Schedule A as it's shown in your textbook. So first is medical expenses, 2019, 7.5%. Now here's the thing. You have to get to no medical expenses are deductible until you get over 7.5%. So that's the tricky part. So if you look on the Schedule A, you calculate up all your medical expenses, then you calculate 7.5% of AGI. That was the change that happened right at the end of 2019. And the textbook has 10%. It's actually 7.5%. You'll see that in the updated version. But the point is, you have to figure out, you have to know what your AGI is. So this is another example why AGI is so important, because it's going to affect how much of your medical expenses are deductible. So only if it's more than 7.5, not up to 7.5, not on top of 7.5, but only if it's more than. So only the amount over, not all of it once it gets to that point or anything. So you're going to subtract from your medical expenses your 7.5% of AGI. If it's negative or zero, then you're just gonna not put anything. You don't put that negative number on the Schedule A. You just go, oh, okay, none of my medical expenses are deductible, and go on. All right. So things to remember about medical expenses: if you're reimbursed by insurance, then it doesn't count as a medical expense. If you take money out of an HSA to pay for expense, that's not counted as a medical expense. So anything that is covered by somebody else, even if it's later, okay? Well, if you pay it in 1 year and it gets reimbursed in the next, then technically you can deduct it in the current year. But then if you get that, if it had a tax benefit and you get it back in the next year, it's actually taxable. So generally, issue is if you expect reimbursement, don't count it, that sort of thing. And it's who you pay for. It can only be yourself, or your spouse, or your dependents. So if you pay a medical expense for just somebody random on the street, that is not a medical expense. So that's an issue that sometimes comes up when people pay expenses. So that's another time when the determination of who is a dependent is important, even though there isn't an actual deduction for it being a dependent. So basically, what is the standard to be a medical expense? Anything that is typically doctor prescribed, but it can't be for the maintenance of your general health. Can't just make you healthier. It can't be just going to the gym because you think that because exercise is good for you. Can't be a travel to warmer temperatures in Florida because you're susceptible. It makes you feel better and you get away from smog or something of the city. Those are not going to. You have to have a specific medical condition, and there has to be a doctor prescription or something of that nature that prescribes that. Now, we have been pretty broad in the types of practitioners. The IRS has not, so what we might say holistic or alternative medicine practitioners, they have not shied away from approving expenses that might be acupuncture or acupressure or some other of those, as long as there is a medical condition that is being treated. They haven't really said, oh, that's not really a acceptable method. As long as it's legal under the law, then it's probably okay. Now, of course, medical marijuana has been a little bit murky on that, and it still is, but as long as you are treating a medical condition, I think you're going to be okay. Now, what if you have to do something substantial, what we might call a capital expenditure, change your house, that sort of thing? Now you have another issue. If that change to your house actually makes the value of the property go up, then you have to take out that amount that it made the property value go up from the amount that's deductible. So if you add a filtration system, let's say you have a really severe form of asthma, so you get a prescription for the doctor says you have got to do something about the way your air is circulating in your house. You paid $20,000 for this special system in your house, but it raises the value of your property by $10,000. Then the difference, the additional $10,000 you spent that didn't affect the value of your property, is your expense. The other part that did make the value go up is not. So the typical one here is a hot tub. First of all, you got to get a doctor that says you need this for a particular situation, medical condition, but then the IRS could come back and argue, well, the value of your property goes up because you have a hot tub, and you'll be able to advertise that. Now, to the extent you can make an argument that, no, my value of my house property did not go up, so just to give you a really extreme example, I read a case where a family, again, a situation where this person had an immune deficiency. They had to have literally a clean house, so they spent over $240,000 retrofitting their home so that the air was multi-micron filtered in such a way that it was just crazy, so that it did not threaten this person's health. IRS disallowed the $240,000, saying that it increased the value of the house. They went to court. and the taxpayers won in the sense that they basically were able to show that to any other person, this did not increase the value of the house. Yes, they spent $240,000, but really somebody else without that condition would not necessarily see that as a value. And they documented that and got real estate appraisers to tell them that, and they won. The IRS lost the case, and it was accepted as a deduction for medical expenses. Okay, so getting back and forth to get medical treatment is deductible. Long-term care, and there's some limits on that based on age, but that you can look up as needed. Okay, some limits on your transportation costs. You can either use the exact expenses or per miles to and from doctors, hospitals, things like that. There's limits on how many people, you can take somebody with you to get treatment. Let's say you go to the hospital for out of town, you fly to a specialized St. Jude's Cancer Center for surgery. That could be deductible, and a person coming with you. However, there are limits on the amount you can spend per night at a hotel staying. So it would be reasonable that someone would need to accompany you, especially if it was a minor getting the treatment, to go there. So you'd need to transport both folks, and that could be deductible. State and local taxes. These are pretty straightforward. We're looking at real estate taxes, state, local income taxes, any of your foreign taxes. The problem is that now under this change in this tax law, that this total amount of taxes are limited to $10,000, and only $5,000 for marriage filing separately, $10,000 for everybody else. So means that they become less valuable. So in places where you pay a lot of state and local taxes, chances are you're going to be well over that amount, and anything above the $10,000 isn't going to do you any good. So this is kind of the opposite of what happens with medical expenses. If you get to a certain amount here, no additional taxes you pay helps. With the medical expenses, it wasn't until you get to a certain level that any of them do you any good. So kind of a different approach. So real estate, really on everything, your principal residence, other properties that you have. Now, if they are rental properties, then you may want to take them not as an itemized deduction, but as a rental deduction, because then it would be for AGI. Because remember, all itemized deductions are from AGI. They do not reduce your AGI, they reduce your taxable income, but not your AGI. So there is some in the way of personal property taxes. In the state of Pennsylvania, just as a warning, there is no personal property tax on your car. You pay a license fee. It's a flat amount. It doesn't matter how big your car, how valuable your car is. And so therefore it is not deductible. It has to be based on the value of the property. So if you drive the biggest beater in the world, you pay the same rate as if you are driving a Hummer, okay, in Pennsylvania at least. But other states have it value based on you pay based on the value of the property, and that part of it, the part that's paid on value, would be a personal property tax that's deductible. Okay, now we've talked about this tax benefit rule, and we talked about the income coming in. Again, if you deduct it 1 year, and again you have to have enough total itemized deductions to make it valuable to you, then when you receive a refund of those state or local, any of the taxes you got a benefit from, whether it be, doesn't matter if it's local, we have the wonderful privilege in Pennsylvania of having both state and local income taxes, both deductible, both you could get a refund from, and if you deducted it and got a refund the next year, it would be taxable income. So we have and this says for 2018, this is also true for 2019, can either take the local, state and local income taxes or the sales taxes, but not both. And so what happens, like it says there, if you have a state income tax, generally that's going to be higher. In states, and there are 7 that don't have a state income tax, that's why this sales tax deduction is there. And there's some ways of estimating that, because the chances of you keeping all your records to know how much sales tax you paid on all of your items you bought would be next to zero chance that would be kept. But this is still in effect and such. But again, either one you choose is still limited by the $10,000. Okay. There's a sales tax calculator on the IRS website that uses tables and things, and then you can add to that specific sales tax on like a big item, because if you buy a car in a year, you're going to pay a boatload of sales tax on that car purchase, and that would be in addition to your normal purchases of clothing and other things where you might have taxes. Now, most of the time, it depends, and it depends on where you are. Our sales taxes, because it's not on food, not on clothing in Pennsylvania, it tends to be lower, and the tables referred to in the slides consider that. So you have to know the table has to be very involved, meaning it has to have it for each state, because it's based on what is taxable in that state for sales taxes. Foreign taxes, the idea, if you pay them overseas, you can take a credit for foreign income taxes. So it's usually better off to take a credit and reduce your tax liability on the income that you pay taxes on in a foreign country. So we're going to end there with part 1 and come back and get into interest and the other itemized deductions in part 2.